Welcome to This Explainer. Have you ever looked at the state of the economy and thought, man, this just doesn't make any sense? Well, you're definitely not alone. Today, we're diving into why financial markets frequently behave completely irrationally, totally defying both logic and hard data. Let's kick things off with a crucial question that challenges pretty much everything traditional economics has taught us about investing. For decades, traditional models have tried to convince us that investors are perfectly rational, that markets are these efficient mathematical machines. But as we're going to see, the reality on the ground, and especially in corporate boardrooms, is vastly different. So, are financial markets perfectly rational machines, or are they really just a collection of persistent myths? Here's our agenda for today. 1. The illusion of rationality. 2. Real estate mythologies. 3. The power of gurus. 4. The artificial engine. And finally, navigating the uncertainty. All right, let's jump right into section 1, the illusion of rationality, the problem with traditional economics. Conventional finance loves these neat little mathematical models where every anomaly gets magically arbitraged away by perfectly logical actors. But honestly, those models completely ignore reality. They ignore information asymmetry, market noise, and the sheer absolute unpredictability of human emotion. To truly grasp what's happening in the market, we have to stop staring at spreadsheets and start looking at human beliefs. The truth is, financial markets are frequently driven by human psychology, artificial stimulus, and incredibly persistent industry myths. The core problem with traditional economics is this baked-in assumption that everyone acts in their own best mathematical interest all the time. But we're humans, not algorithms. We are driven by fear, by greed, and by deeply ingrained habits that just flat-out defy logic. Moving right along to section 2, real estate mythologies when belief outmuscles data. So there's this list of unquestioned dogmas in commercial real estate that practitioners just blindly follow, even when the data actively tells them not to. We call these mythologies. They're beliefs that maybe started from a tiny seed of historical truth, but now they're treated as absolute gospel, completely regardless of the actual evidence. Take, for instance, the absolute certainty that real estate is always an inflation hedge. Analytically, we know this doesn't consistently hold true, especially when inflation catches us by surprise. Or think about the assumption that cap rates perfectly indicate underlying risk. Or the widespread belief that major global cities always offer better risk-adjusted returns, despite the massive downside volatility they show during crises. Yet, despite clear evidence to the contrary, the industry just operates as if these are undeniable laws of physics. And the disconnect between these myths and reality is just astounding. Traditional belief dictates that real estate is a safe hedge guaranteeing real growth. But then you look at the market reality. UK office capital values actually saw a staggering 60% real loss over a multi-decade period from the late 80s into recent years. What is truly fascinating and honestly kind of terrifying is that when practitioners are shown this 60% drop using their very own industry data, they literally just refuse to believe it. They reject the data right out of hand because it conflicts with their embedded mythology. It's a perfect example of belief completely outmuscling data. Which brings us to section 3, the power of gurus, the human element in decision-making. To figure out why these myths survive despite the hard data, we actually need to look all the way back to the 1920s and a brilliant Cambridge thinker named Frank Ramsey. He realized something pretty profound about the human mind. His concept of subjective probability basically reveals that under conditions of uncertainty, a person's prior expectations act as an incredibly powerful filter. If your prior belief is strong enough, like the unshakable conviction that commercial property always goes up, you aren't going to rationally adjust your view when new, negative data arrives. You'll just dismiss the data entirely. Your subjective belief effectively shapes your reality, completely overriding the objective facts right in front of you. And this exact dynamic plays out in corporate boardrooms all the time. You see, commercial real estate is a private market with really thin transactions. Big deals don't just happen every day. So when an investment committee meets, it's rarely the perfectly calibrated financial model that actually wins the day. Usually a powerful senior individual, a chief investment officer, or a market guru will just override the math based on their gut feeling or some outdated industry rule of thumb. Because these highly influential folks act as role models within their firms, their subjective beliefs trickle right down through the ranks. This top-down influence from gurus keeps these irrational market myths alive and kicking, completely bypassing any rational model-based decision-making. Okay, shifting gears to section 4, the artificial engine, stimulus, and macroeconomics. Moving away from human psychology and zooming out to the broader macroeconomic picture, legendary investor Howard Marks gives us this brilliant perspective on what's actually propping up these markets today. He uses this incredible metaphor. He says, imagine the economy as a stalled car. It looks like it's moving steadily down the road, but that's only because a massive tow truck, government stimulus, is pulling it. When we actually look under the hood, top-line revenue growth for a lot of businesses is surprisingly weak. Corporate profit gains are mostly coming from cost-cutting and job reduction, not actual organic expansion. So the absolute critical question we have to ask ourselves is, what happens when the tow truck unhooks the car? Will the economy run on its own, or is it just going to sputter to a halt? By artificially lowering interest rates to near zero, the government kicks off a pretty dangerous chain reaction. Let's trace this domino effect together. Step 1. Low rates act as a massive direct subsidy to financial institutions, basically letting them borrow for next to nothing. Step 2. Everyday investors get completely starved of safe yield. Think about a pensioner who gets zero return on a money market fund. They suddenly feel forced to become a high-yield bond investor just to survive. This frantic chase for yield pushes riskier asset prices up to unnatural bubble-like heights. And finally, step 3. Maintaining things at these artificial levels requires expanding the money supply, which weakens the US dollar and dramatically ramps up the risk of higher inflation down the road. It's also really crucial to note Howard Marks' observation that today's business landscape is heavily influenced by intense political and social pressures. This adds a whole new layer of unpredictability to the market. He points out governments actively dictating private sector pay, a distinct lack of private sector experience among political leaders, and a growing populist anti-business sentiment globally. Now, keeping it completely objective here, from Mark's perspective, when successful businesses and financial institutions are viewed as the enemy rather than engines of progress, the long-term outlook for a vibrant, self-sustaining recovery becomes incredibly murky. All right, let's wrap things up with Section 5. Navigating the uncertainty, protecting your portfolio. So how exactly can a rational investor maneuver through an irrational, stimulus-driven market that's filled with stubborn gurus? Well, instead of just ignoring the warning signs, Mark suggests some concrete defensive actions. If you believe a weakened dollar and increased interest rates are on the horizon, traditional long-term bonds are incredibly dangerous. Marx advocates for flexibility. He suggests buying Treasury inflation-protected securities, or TIPS, to directly hedge against rising prices. He also recommends investing in floating-rate debt, because your yield actually climbs as interest rates climb. Acquiring non-US assets or foreign currencies can help hedge against domestic dollar weakness, too. And honestly, sometimes the bravest action is simply holding cash, giving yourself the dry powder necessary to strike when interest rates ultimately force asset prices back down to reality. I want to leave you with this final, provocative thought. Simply worrying about the economy just isn't enough unless you're actually willing to take decisive action to protect yourself from the illusions of the market. Howard Marks points out that when investors say they're worried about inflation, but then they only dedicate 5 or 10% of their portfolio to protecting against it, they are effectively doing nothing. To truly guard against these macroeconomic forces, to actually protect yourself from the mythologies and the gurus, requires committing maybe 30 to 40% of your strategy to defense. So, are you willing to dedicate enough of your portfolio to actually protect against these risks? Or are you just rearranging deck chairs on the Titanic? Thank you so much for joining me on this explainer, and I really hope this helps you see past the illusions to navigate the reality of the market.